So guys, IFRS 5, non-current assets held for sale. All right, so let's summarize it before we get in detail to see what's happening. So IFRS 5, non-current asset held for sale. All right, so when we understand what is going on now with this standard. All right, so guys, non-current assets held for sale. We're looking at assets now that the company is no longer using. They've decided to classify these assets for sale. So these are assets. All right. These assets have been classified as being on sale. All right. So these assets now, they're being classified as being on sale. The company is no longer using these assets. All right. Has stopped using the asset. All right. We have stopped using the asset. All right. With the intention to sell the asset. All right. So that's basically what's happening with regards to this asset. All right. Good thing, no, in terms of this asset now, our intention is now to sell. But now I want you to note something, right, with regards to this asset. Because now these assets are being held for sale, all right, it means now we no longer have value news, all right, in terms of this asset. There's no more value news. Because remember, we said value news arises from using the asset. All right. But now, because we have stopped using the asset, there's no more value news. All right. So, which means now, in terms of this impairment of these assets, all right, is going to be the difference between, of course, carrying amount and recoverable amount. Right. So that's how we calculate. But however, now the recoverable amount is only based on is equal to fair value less cost to sell. So now, remember when you did IS 36 impairment, all right? If it was under IS 36, we looked at impairment of the assets, but these assets now, they were being used, all right? So if you have an asset that you're using, we said you have a choice, all right? In other words, the best value of this asset can be realized through continuing using the asset or selling the asset. But however, now under IFRS 5, non-current assets held for sale, this asset you have stopped using it, which imply now the value of the asset can only be recovered through sale. So impairment now is now calculated by taking the difference. Literally, we can say fair value less cost to sell minus carrying amount. Right, so that's how we go about it. So IFRS 5 asset, all right, I measured it lower of carrying amount and fair value less cost to sell. All right, some of you guys, you'll be applying for accounting jobs. They love examining this question, right? If it's audit or accounting, they say, if those one of those audit firms or accounting companies, right, that say they give you some little bit of calculation type of interviews, right? They normally examine to say maybe write the measurement of IFRS 5 assets, right? Non-current assets held for sale. So instead, it's measured at law of carrying amount and fair value less cost to sell. So that's how we measure these assets there. All right. So literally that is what we have, all right, in terms of this. All right. Now let's proceed now, right, into our slides now to see what's going on, the notes. All right. So the measurement, the scope under IFRS 5, measurement provision of IFRS applies to all non-current assets held for sale and disposal group, except for, so in terms of this, remember, even under IAS 36, we had some assets where we did not allocate the impairment loss. So here, we're saying impairment loss, we do not allocate it to this asset. Deferred tax, employee benefits, financial assets, investment property on fair value model, agricultural assets, rights under insurance contract. Of course, you just need to worry about these ones that we highlighted there because that's what you guys cover. Right, take note, this is an exclusion to measurement and not classification. All right? Now, what does this imply? These items will not be measured in terms of the requirements of IFRS 5. They will not be measured at the law of carrying amount in favor of the less cost to sell of the items. These items will continue being measured under other standards. All right, I'm going to show you when you do the cash generating unit. However, classified and presented as IFRS 5 once they meet the criteria to be held for sale. All right. This is important when you start accounting for disposal groups. Let's look at it, all right, in regards to this. Classification. So we classify asset as non-current asset held for sale, disposal group as held for sale. If, so the first thing, all right, that determines the classification of our asset as held for sale, we're looking at it from the angle now. If the carrying value will be recovered through sale, all right, the moment they tell us that the carrying value is recovered through sale, now this asset is classified as held for sale rather than continuing use. All right. But now, IFRS 5 does not include assets or disposal group to be abandoned. What does it mean to be abandoned? So if you decided to stop using an asset, all right, and then you just leave it like that, now we can't classify that asset as held for sale. The only assets that we classify as held for sale are those assets now that we are saying, no, these ones we are going to dispose. That's the one we classified as held for sale. So if an asset is abandoned, we do not include it here. All right. Sorry. And then if abandoned asset or disposal group meets the definition of discontinued operation, then it is disclosed discontinued operation from that date that it ceased to be used. So it's classified as discontinued operation, not non-current asset held for sale. All right, we're going to look into it. Now, for an asset to be classified as held for sale, the asset must be available for immediate sale in present condition. All right, so in regards to this, classification of asset as held for sale. All right. Now we're saying in regards to this, asset must be available for sale in present condition. Now, what does this mean? It means now, we have some circumstances whereby the asset needs to be renovated, needs to be fixed and all that before you sell it. If that's the case, that asset is not yet available for sale. An asset is available for sale if, regardless of its condition, right, if it has broken tires, whatever, you're saying no, in its state, it is available for sale. You don't need to do any modification. So that's how the asset will classify as held for sale then. Now, and sale must be highly probable. All right? So the other part, sale must be highly probable. All right. On your weekly quiz, they might examine you these things. The sale must be highly probable. What does it mean? A sale is highly probable now if management is committed to plan to sell an asset or disposal group. So in literally now, what it means now is the sale must be approved by the management. All right. And then the company is actively locating a buyer. So in other words, they're doing advertisements, all right? Yeah, there's different forms of advertising. They're marketing the asset, all right? It can be by word of mouth, any form of adverts that they use. So in regards to this, they're actively locating a buyer, all right? Now, the asset is actively marketed at a reasonable price. That is the fair value of the asset. So literally what it means now is the asset is not overpriced. All right, that's what we have. And then the sale is expected to be completed within 1 year from date of classification. All right, what does it mean in regards to this? All right, it means now, in terms of the sale, a lot of our asset, we plan to complete the sale within 12 months. That is the idea. Of course, there could be exceptions, right, in circumstances that are beyond the company's control, right? In that case, they can make exceptions to say, no, the sale can be delayed. But the plan is to say the sale should be completed within 1 year. Right, that's what we have in regards to that part. And then it is unlikely to be significant change to plan of sale. So in other words, it is unlikely that you're going to withdraw your decision to sell the asset. So if that's the case, then your asset now should be classified as non-current asset held for sale. All right. Then in statement of financial position, all right, statement of financial position. So what we do, remember we have assets, right? We have non-current assets, all right? So we record them like this, right? And then we have current assets. Now, non-current assets held for sale, we record them under current assets. Why? The logic is because remember, the sale is expected to be completed within 12 months. 12 months. So in other words, we're holding these assets for a period that's less than 12 months. That's why we classify it as a current asset. But remember, property, plant, and equipment items, we classify them as non-current assets. All right? All right. But now, the moment we have non-current assets are held for sale, it's now a current asset. It's no longer a non-current asset. Remember, these on PPE, we expect to hold them for more than 12 months. All right. So that's the logic behind this. All right. Then assets available for distribution to owners. All right. They must meet also the same criteria. All right. Then we have disposal group. Now, a disposal group is a group of assets, including goodwill. Right? If disposal group is a CGU, cash generating unit, to be disposed. The same principle we did on disposal group under impairment loss is the same principle we are looking at. Remember, we said disposal group now is, it could be a division of a company that is in position to generate income on its own. Now you have decided to sell that division. All right, that's what we are looking at. Now, together as a group or in a single transaction, include liability associated with those assets that will be transferred. Note, this disposal group includes all assets and liabilities, both current and non-current, to be sold together. All right. Now, then we allocate impairment according to IS 36, right? Paragraph 104. Of course, remember we did look at the allocation of impairment loss. So the same principle still applies here under IFRS 5. All right. So we're going to look into it just now. Let's look at this disposal group, all right, to see now what's going on there. All right. So in terms of this, we have an example, right, that we have there. So it says, prepare the journal entries, right, excluding deferred tax. Right, prepare the journal entries, excluding deferred tax, all right, to record the impairment loss on 1st of July 2024 in the records of SFRI Limited. So we want to do now the journal entries of the company that we have there. Now, how are we going to process now our journal entries? That's what we want to look at, all right? So, SRFI Limited is a manufacturer of do-it-yourself equipment. The entity consists of two departments, namely manufacturing and marketing. As a result of the low demand for do-it-yourself equipment experienced in the younger market, SRFI decided on 1st of July 2014 to sell their manufacturing department. Okay, can you guys see, or should I increase the font? It's too small. Eh?
Yes, please increase the font, yes. Thank you.
Is it fine like this? Or should I increase it further?
Yes, it's fine.
All right, okay, cool. All right, so it's saying SRFI Limited is a manufacturer of do-it-yourself equipment. The entity consists of two departments, namely manufacturing and marketing. As a result of the low demand for do-it-yourself equipment experienced in the younger market, SFRI decided on 1st of July 2014 to sell their manufacturing department. All right. Now, what does it mean? So it means now, all right, our asset. All right. Okay, cool. So it means now, in terms of this, all right, our asset, right? On 1st of July, right? The asset or the group, the disposal group is classified as held for sale, right? So that means now it's now a non-current asset held for sale, right? We have classified it as held for sale. It's a non-current asset held for sale. Now, what does it then mean? All the held for sale requirements of the accounting standard IFRS 5 were met on 1st of July 2014. The manufacturing department's trial balance on 1st of July 2014 was as follows. Now, this is what we have, all right, as forming part of the trial balance. So if investment property carried at cost, investment property carried at fair value, property, plant and equipment at cost, all right, and then we have, of course, property on cost model, intangible asset on cost model, and then allocated goodwill. So these are the assets that we have there. So what are we going to need? Well, we're going to need to calculate the carrying amount of the cash generating unit on 1st of July 2014. Right? So what we need to do with that. So let's calculate carrying amount of cash generating unit. All right? On 1st of July 2014. Debt classified as held for sale. All right. So we're going to calculate this. So in regards to this, now we list the assets that we have there. So we have investment property, all right, that is at cost model. All right, investment property that we're carrying at cost. So in regards to this, its value is 30,000. So it's sitting at 30,000. All right, then we have investment property under fair value model. All right, this one is carried under the fair value model. Right, so it's sitting at 50,000 there. Remember, if you're not, right, why am I using this amount? Remember, in terms of this question, they told me that these balances are on 1st of July. Then we have property, plant, and equipment under cost as well. So we have property, plant, and equipment. So we have property, plant, and equipment under cost as well. So the value for property, plant, and equipment in regards to this is given, all right, is 120,000. All right, so we have 120. And then after that, we have property on cost, all right, in regards to this. We have property on cost. All right, so the property on cost is sitting at 300,000. All right, and then we have intangible asset on cost 100,000. Cost sitting at 100,000 there. Right? So these are the balances that we have there. Then we have allocated goodwill. Allocated goodwill. So in terms of this, the allocated goodwill is sitting at 80,000. Right, so basically these are the assets that we have on this debt. Then we add together these assets. So it's going to give us the carrying amount of the CGU unit. So the carrying amount of our cash generating unit is sitting at this balance. So this is the value now that we have as our carrying amount of the CGU. Right. Any questions so far? All right, let's read through the information that we were presented there. All right. The fair value of the disposal group was determined as 600,000 on 1st of July 2014 by a reliable valuator. SRFI, we have to incur cost of 20,000 to complete the sale. The manufacturing department also constitutes a cash generating unit and the company applies IAS 36 before IFRS 5. It has been determined that similar investment property carried at fair value in the marketplace is 40,000 and 30,000 on 1st of July 2014 and 31 December 2014 respectively. Now, what does it mean in terms of this? Remember now, but if you look at our scope. All right, let's quickly go there and our scope. Now, we said in terms of the scope, IFRS 5, the measurement of IFRS 5, which is, of course, the less of fair value less carrying amount, all right, does not apply to this asset, all right? In other words, we're saying now, investment property, all right, investment property measured under fair value model. So it means now, if we have a fair value of investment property under the fair value model, we measure that investment using the fair value. So now we are given the fair value of our investment property. You see, now the fair value for investment property on 1st of July 2014, the total is 40,000. But here it's given as 50, which means now in the CGU, we're going to record investment property at this amount, all right? The carrying amount. So the investment property is measured at fair value. Therefore, we use most recent fair value amount. All right? So that is the logic behind this part. We're using the fair value model, so we use the most recent fair value to measure this investment property. All right? So the most recent was given as 40,000. So that means now the carrying amount of our cash generating unit is 670,000. Now let's do the recoverable amount, all right, of our CGU, all right, in terms of this, or what you can call fair value less cost to sell. So in terms of the given information, all right, now we are given, do you see, in regards to this, the fair value of the disposal group was 600,000 on 1st of July 2014. So fair value is 600, all right? And then SFR incur cost of 20,000 to complete the sale. So these are selling cost. So which means fair value less cost to sell now is going to be 600 minus 520. All right? So you have 600,000 minus 500 minus 20,000, right? Which will give us 520. Right. Then now, which means now do you see the carrying amount is more than fair value less cost to sell. So that's to say there is impairment loss.
Sorry, Ian, it's 580.
Oh, it's 580. Oh, thank you. It becomes 580. Right. So which means now impairment loss, we're going to take 670 minus 580. Thank you. Right. So that's what will give us impairment loss. All right. Remember we said impairment loss is when? So impairment loss is when carrying amount is more than fair value less cost to sell. All right. So that's when we have impairment loss. So here we're saying, no, there's impairment loss of 90,000. So this impairment loss of 90,000 is an expense. We record it in the statement of profit and loss. All right. Now, this impairment loss of 90,000, we now need to allocate it to our assets. All right. So how are we going to allocate the impairment loss? So we then allocate it now to the asset, right, that do not include these ones. So which means now the impairment loss, we do not allocate it to these assets. So on the list that we have, do you see, we only have investment property at fair value model. All right. So in terms of this, look at the list of our assets. We have investment property at cost, investment property under fair value. So we do not allocate impairment loss to this one because it's outside the scope, the measurement of IFRS 5. So it's, as in this case, all right, let's just write small loss. So investment property under fair value method, all right, measurement is outside the scope of IFRS 5. So in this regard now, therefore, we do not allocate impairment loss. Impairment loss to these ones. All right. So basically, that's what we. So we are not going to allocate impairment loss to these assets. So we're going to allocate impairment loss to the other assets there. All right. So the next step before, remember the question is asking for journal entry, but before we process the journal, all right, in regards to this, we first need to do the allocation of the assets to this, all right? The impairment loss, to these assets. So we allocate impairment loss. Payment loss based on carrying amount of the assets. All right. So now in regards to this list now, we have the different assets that we have there. Right. So in terms of this, we have investment property under cost, and then we have, of course, property, plant, and equipment. All right. Let me just drag it down so that we pull through all the assets there. Then we have goodwill. All right. And then we do the total balances. All right. To do the carrying amount, we have 30. And then here we have 120 there. Right, then we can do our total. So the total value of the assets, right, that we have is sitting at this amount. Right? So we have 630. Now I want to allocate the 90,000. Right? We want to allocate the 90,000 to these assets now. Right, how are we going to do that? So for starters, we first allocate to goodwill. All right, so first allocate to goodwill. I'm sure you guys still remember on our previous class where we did the allocation fully to goodwill. So which means now we're going to minus, so goodwill is going to be sitting at 0. Actually, let's just be more presentable. Let's write it like this. All right. So first allocate payment loss to goodwill. All right. So which means now we have to allocate 80,000 to goodwill. All right. Let's remove goodwill here. All right. So record 0 there. So it becomes 550. So goodwill is fully deducted. So which means now the next thing that we need to do now, the allocation of investment property. So investment property is 30,000 carrying amount. We divide by the total, which is 550,000. So our total there is 550,000. Then we say times, all right? Times what? Our impairment loss that we calculated there, all right? Remember it was 90,000, but 90,000 minus 80, which were allocated to goodwill, would give us 10,000. All right. So that's to say this is what we then allocate to investment property under the cost model. All right. Let me just write there. So remaining impairment loss. All right. It's going to be 90,000 minus 80,000. So we remain with 10,000. In case somebody will be wondering where's the 10,000 from. And then we allocate again to property, plant, and equipment. So the carrying amount of 120 divided by the total of 50 times 10,000. All right, we do the same under property at cost. All right, so we have it there times 10,000. All right, we do the same on intangible assets. Right, so that's how we allocate our impairment loss in this regard. Right. So in terms of this, so we have these amounts is the allocated impairment loss. The principles are almost the same as what we did under IFRS, under IAS 36 impairment losses, except that the measurement, when we have current assets held and non-current assets held for sale, in regards to this now, we just don't have value in use. Right? But otherwise, the other principles are still the same. All right. Any questions for me so far, guys? Right. Then to process the journal, so we debit impairment loss, P&L. It's an expense. Right? So we record it there. So our first calculation, the total impairment, we did calculate it at 90,000. So we debit 90,000 impairment. Now, this impairment, remember we allocate, all right, perfect, Alice. This impairment, we allocated it now. Right? So you're saying, no, investment property, we have 545. Right? So we're going to debit, all right, accumulated impairment loss. All right? That's what we allocated to. In this regard, we allocated to investment property and the cost model. All right? So SFP. Right? So it's sitting at, we allocated there. So we allocated 545, right? And the calculation there. Then we've accumulated impairment loss. All right? That we allocated to the next asset, which is property, plant, and equipment. It's easy, right? Easy stuff. SFP. All you just need is probably spend a bit of time on this, right? But my colleagues who are in the corporate, I'm sure you agree with me that you work with these things, right? Almost every now and then. So you're not doing yourself a favor by mastering this to pass, but also if you work in an accounting environment, all right, you're going to need this type of transactions, right? 5455. And then you have accumulated impairment loss, right, which you allocated to intangible asset. Right? SFP. So it's going to take you again to 1818. Then accumulated impairment loss for goodwill. Right? That you allocated to goodwill. Right? Regards to this. So you have your goodwill sitting at 0 there. SFP. So you allocated 80,000 to goodwill. So that's how you could have processed now the journal entry, all right, in regards to the allocation now of your impairment loss. Questions, guys? Right. Now, our next part of the question, it says, prepare the journal entries, excluding deferred tax, to record impairment loss on 31 December 2014. All right, we're now looking at 31 December 2014. Let's see now what is happening now, 31 December 2014. Now, on 31 December 2014, all right, we've been told now that with regards to this, all right, let's first calculate the carrying amount. All right, on 31 December 2014, we're going to need now the carrying amount of the disposal group on this debt. All right, so we're going to calculate carrying amount of the disposal group. On 31 December 2014. So that's the first thing that we do. So we list all those assets that we had there. All right, these assets that we have here, we're going to list them. We want to calculate their carrying amount, of course, excluding goodwill, because goodwill is now sitting at 0 there. All right. So in terms of this, remember goodwill has been fully impaired, so it's sitting at 0. Then investment property. So what is the carrying amount of investment property? Now look, the investment property, all right, on 1st of July 2014, it had a carrying amount of 30,000, but we impaired it. We did allocate impairment loss of 545. So minus 545, which means now 30,000 minus 545 is now the carrying amount of this investment property. Then investment property under fair value. We then assess, is there a new fair value of this property on this debt? You see, it has been determined that similar investment property carried at fair value in the marketplace is 40,000 and 30,000, 1st of July 2014 and 31 December 2014. So now the new carrying amount of our investment property is 1,000. It's given. All right. Then we have property, plant, and equipment. So on 1st of July, the property, plant, and equipment had a value of 120,000. Then we allocated impairment loss, property, plant, and equipment of 2182. All right. So which means now the new carrying amount of our asset is going to be this balance. All right, something to note, all right? Probably I forgot to mention then. When an asset is classified as held for sale, we stop depreciating that asset. All right, let me just write it up there, all right? So that maybe, right, so when asset is classified as held for sale, right, when an asset is classified as held for sale, we stop depreciating that asset. All right. So that is why, if you're not, all right, on these assets, property, plant, and equipment, we only deducted impairment loss. We did not deduct depreciation because it's now held for sale. All right. The same applies on property, on cost. So the property on cost is carrying amount on 1st of July, right, was 300,000. Then we allocated impairment loss of 54, 55. So the new carrying amount will be the difference between these two amounts there. All right, so in regards to this, the difference between these two amounts, so then take us to this balance. Then we do the same on intangible assets. All right, so on the intangible assets, what do we have? We have 100,000 carrying amount, then minus the allocated impairment loss, which is 1818. All right, that would imply our value in this regard will be this amount. So that's the amount that we have in regards to this. Then goodwill, of course, goodwill has been fully impaired. So we had 80,000 minus 80,000. So goodwill is sitting at 0 there. So these are the carrying amount of our cash generating unit on this debt, right? Where the non-current asset for sale is this 570 there. Right, let's see, all right? Now, so we still don't depreciate the asset, even if it's held for sale for more than a year, even though the intentional plan was to hold. Yes. So in regards to this, as long as there's no intention, remember we spoke about whereby the plan to sell is not going to change, right? As long as we have not changed our plan of selling the asset, we do not calculate depreciation. So I agree with you 100%, no depreciation there. Right. Then the carrying amount of our asset will be 570,000. Now, what is the fair value less cost to sell, right, in regards to this? So the fair value less cost to sell is what we need to determine, right? The fair value less cost to sell, it's given in how much, right? The fair value less cost to sell on 31 December is 530,000. So it's given. So we have 540,000, which means now impairment loss. So it's going to be 570 minus 530,000. So that's what's going to give us impairment loss in this regard. So it'll be sitting at 40,000. So 40,000 now is our impairment loss of the non-current asset held for sale. Are you guys with me there?
Yes.
All right. Fantastic. So that is our impairment loss now, right? That we're sitting with in regards to this part of the question. All right. Now in regards to this, all right, with that now being mentioned, all right, we now need to process the journal entry, all right, in regards to this part of the question. Right, we now need to reallocate, all right, in terms of this, we can reallocate the impairment loss, of course, to the remaining assets, all right, in terms of this. We can allocate to the remaining assets, all right, in this case, we have investment property cost and all that, those other assets, right? We need to allocate it, but if a question is silent, no need to allocate it. So 31 December 2014. Right, so the question that we are looking at in regards to this, there was no mention, right, about the allocation of the impairment loss to those other assets. So what do we do? So we can debit impairment loss, right, P&L. Then we credit non-current asset held for sale. held for sale. So saying no, the value for non-current assets held for sale is now reducing with 40,000. Right, we can process our journal sitting like this. All right. Any questions for me there, guys? All right. Cool, guys. So if you guys don't have questions, I think that's basically it, all right, with regards to non-current assets held for sale. So I'm going to see you on Saturday, all right, where we finish this topic, all right, and then on the what do you call this? On Sunday, we look at integrated patients, all right. But of course, I want you guys to run through the rest of these questions, all right, to have detailed understanding in regards to this. Please do not fall behind, all right. When you fall behind now, you'll be lost throughout the class. All right. Have a wonderful evening, guys. Bye.
Rồi Ian.
All right. Bye.
Bye.
Bye.